Hi, mining community. Welcome back to another episode of the Dig Deep, the Mining Podcast. And today's guest is Adam Davidson, who's the CEO of Trident Resources, who are a diverse mining royalty and streaming company, providing investors with exposure to a mix of base and precious metals, bulk materials, excluding thermal coal, and battery metals. Adam came through the US Marine Corps and then went into the financial industry or sector, and worked for a number of equity funds before joining Trident. So I'm going to let Adam tell us a little bit more about his background and his career before he joined Trident Resources, and then we can talk a little bit more detail about royalty and streaming. So I'd like to welcome Adam. How you doing, Adam?
I'm good, thank you.
No worries. Appreciate you taking the time to do this podcast. Appreciate if you can let the audience know a little bit about you, about your background, and generally speaking, just a brief overview from when you graduated and your journey through your career to where you are today.
Yeah, sure. Yeah, maybe I'll work backwards. So I joined Trident at sort of the tail end of last year. Prior to that, I'd spent just over 5 years with a group called Resource Capital Funds, which is a mining-focused private equity fund. Worked both in the US and Australia with RCF. And then prior to that was with BMO Capital Markets on the metals and mining on the equity research side. And then before that was in strategic planning with Orica Mining Services, which is the Aussie listed mining services company. I was specifically on their North America side. So yeah, here in Denver. And then worth mentioning, I've got my colleague down in Perth, Trident Reese. So Ty's background, he's a metallurgist by trade, worked for commissioning at Sandfire's DeGrussa and at Boddington's expansion prior to doing his master's in finance and CFA, and subsequently worked for RCF as well for sort of close to 6 years, I think, before making the move at sort of the same time as I. And then with regards to other people involved, we've got 3 advisory groups, so all sort of resource-focused groups. Tamasys Partners out of the UK. We've got Azure Capital and Ashanti Capital, both out of Australia, that sort of support us out of Australasia. And worth flagging, all 3 groups are sort of major shareholders as well. And then our board, we have James Kelly is the chairman. James started with Xstrata, later Glencore, and then was one of the founding team of Greenstone, which is a mining fund based in the UK. We've got Mark Potter, who's currently the CIO of Metal Tiger, which is an AIM-listed mining investment vehicle. But pertinent for us, prior to that, he was the CIO of Anglo Pacific, which is the other mining royalty company listed in the UK. And then we've got Al Gooley, which was just recently appointed a couple weeks ago. And Al is a lawyer that specializes in the resources sector, and he's the managing partner of Fasken's London office. And Fasken's is a large international law firm. So really happy with the team that we've put together.
Yeah. Before we go on to speak about obviously mining, royalty and streaming, can you tell us a little bit about Trident Resources and what your, I suppose, main focus is?
Yeah, sure. So Trident was originally set up as a shell on the LSE. I think there's just a touch under 5 million US at the time it was listed in 2018. And originally the intent was to vend an asset into the vehicle. Ultimately that didn't come to fruition, and it was sort of around the middle of last year that the advisors that set up the vehicle began exploring the royalty approach in more detail, in particular diversified royalty strategy, which we'll talk to later. And that sort of intersected with my and Ty's interest in the space as well. So it's sort of serendipitous. We crossed paths around the same time, and the conversation sort of grew from there until we formally got involved and made the move in October last year. And then really since that time, since joining Trident, it's been a matter of a twofold approach, really getting the vehicle structured and ready such that it could execute on the strategy. And part of that is the relisting onto AIM that we're undergoing right now. So we'll be back on the boards and tradable on June 2nd. So that's been a fair chunk of work. And then probably more importantly, cooking up the pipeline of transactions. The first deal was announced March 25th, and that coincided with the announcement of the new royalty strategy. So really it's been progressing transactions such that we've got a pipeline of stuff we can execute on post-relisting.
Okay, Okay. So obviously Trident is a mining royalty and streaming company. Sort of first off, what is a royalty, and how is it used in mining finance?
Yeah, sure. So mining royalties are effectively you pay an upfront cash consideration to the mining company, and in exchange, you get a percentage of their revenue from that operation or that asset. And there can be a million variations on how that's actually executed, but at a high level, that it's as basic as that. So as you'd expect, that there's existing royalties that you can go out there and acquire, and then there's sort of endless opportunities to write new royalties. Um, but effectively, the royalty, the reason investors like it is it gives you direct exposure to that commodity and the underlying asset. So, if the commodity ticks up 10%, then the company's revenues increase 10%. And that flows straight through to the royalty. So you're not exposed to, because it is top line exposure. You're not exposed to operating costs or capital costs of the asset. So many investors, we've all probably done it. You invest in a mining company, you really like the asset, the commodity's performing well, the asset performs well, but you're not seeing as much flow through to the equity share price as you expect. And that's because between the top line and the bottom line, capital gets chewed up, through, extra drill campaigns, plant expansions, all that sort of stuff, or M&A in many cases. So shareholders can be disappointed. Whereas a royalty sitting at the top line, you get that direct exposure without any of those sort of diluting impacts. That said, you still get the upside of the asset. So if they do drill and then they expand the resource, the reserve, yeah, and that extends the mine life, that rolls to the benefit, because obviously that just extends the life of that stream of revenues. And similar, if they expand the plant, they're using equities money effectively to do that. But you get the benefit of increased throughput. So there are a number of reasons why investors like royalties and like to get their exposure to the mining sector via royalties. And then the sort of natural question is, well, why would the miners accept that if it's a non-dilutive piece of financing that sort of sits over their property in perpetuity? Certainly that wouldn't be appealing. But the reality is, in a market like we're in right now, is probably no better example that in many cases they either can't raise equity, or prices are depressed and they don't want to. So a royalty is obviously a non-dilutive source of financing. So they're open to that, and it's cyclical. I mean, obviously there are certain markets where equities sort of throw in dollars at the mining companies, in which case royalties would be out of favor. But as we know, these things sort of ebb and flow. So royalties tend to have their day, as they come and go. The other piece is relative to debt, it's covenant light. So rather than the mining company going out there and getting a piece of debt that has heavy covenants and a fixed payment schedule, a royalty, that the cash comes into the mining company and then it doesn't start going out until the asset's operating and it's paying and all that sort of thing. So there are a number of benefits on both sides, which is why it does have a place in the mining finance spectrum. I think you're seeing it more and more. They really grew out of North America. You'd see a large precious project get built where there would be a debt component, an equity component, and then a royalty or a stream. Less so in Australia, although that's sort of changing over the last sort of 5 to 8 years, where now you're seeing it becoming a more standard part of the mining finance landscape.
Yeah. So what's the main variables in terms of how a royalty is made up, and who decides the royalties? Obviously, I'll take it's a number of different parties.
Yeah, so there are a few things you consider, obviously, when you're putting a royalty on the table, as an option for a mining company to find as a source of funding. Yeah, obviously the key variables is the percentage, because I mean, effectively it is just a discounted cash flow model. You're modeling out the life of the mine, what you expect those cash flows to be, and then discounting it back to today and ensuring that it meets your return hurdles. And there are a number of factors that play into that, where the mine is located. Is the operator an experienced team with multiple assets, or is this a junior miner with, this being their first asset? Is the legal framework in that particular jurisdiction conducive to royalties? And in some situations, the royalty is pegged to the tenement and secured to the tenement. So even if the operator goes into administration, the royalty survives and continues on. And if the property is picked up by a new company, the royalty turns right back on again. Whereas others, they're purely contractual agreements between the royalty company and the mining company. So if they enter into administration, the royalty is effectively wiped out. So there's a number of these factors that have to go into how we'd be valuing them. Not least of which, obviously, the commodity and that sort of thing. But all these sort of other factors that I mentioned as well play a role into how you view sort of a royalty coming together.
Yeah. So why would investors prefer exposure to mining assets and commodities via royalties versus equity?
Yeah, it really is some of those factors I just mentioned. I think most investors, that they've invested in mining companies, and mining companies have this sort of notorious reputation of finding ways to destroy value. So, even if the commodity is performing well and the asset's performing well, they go off and do M&A or ill-advised expansions and that sort of thing. So mining royalties sort of cut that risk away, but still give you exposure to the direct project. So, that has a certain appeal to investors, particularly generalists and retail investors that say they want to park 3% of their portfolio in mining commodity exposure. Then it becomes a matter of, well, do I invest in one of the majors and get sort of diversified exposure in that way? But I'm really not going to outperform the sector at all. Or do I pick a junior, but then that's incredibly challenging and opaque on which junior is going to outperform? Whereas a royalty portfolio, using a really basic example, you can invest in a mining junior that's producing 100,000 ounces of gold per year, but they're completely exposed to that single asset risk. So a wall failure, for example, could sink a company. Versus a mining royalty company that has an attributable 100,000 ounces of gold production, but it's spread across 7 royalties in 4 different jurisdictions. And you really mitigate a lot of those risks on top of getting, that security structure that I mentioned and the top line exposure rather than bottom line. So, and that's why you see royalty companies valued on such high multiples. In many cases, the big boys are sort of 1.5 times NAV, if plus 1.5 is at times, sort of 2.5. So it sort of falls within that range, and it's pretty linear with regards to your size. So, the more royalties and the more cash flow you have, you sort of march up that sort of valuation curve.
Obviously, there's other mining royalty companies out there. What makes Trident different? And what's your, I suppose, business strategy and your plan?
Yeah, so that's a good question, because I think royalties and streams have been a part of the mining landscape for some time. That said, I think if you rewind the clock back 10 or 15 years and looked at the space of listed mining royalty companies, you'd be surprised. You'd be limited to sort of 3 or 4 options, versus today, it would be sort of 15, 16, and seemingly more sort of all the time. So, it's a long way of saying that although it's definitely not an industry that is in its infancy, you probably characterize it as being in its adolescence. So there are still a lot of opportunities and sort of gaps in the sector, we believe. And one of those gaps, and probably the most prominent, is just the fact that the vast majority of the listed mining royalty sector is either predominantly or exclusively precious metals focused. And that really is because the genesis of these came out of North America financing precious metals mines. So there's a very limited number of royalty codes that pursue royalties outside of the precious space, despite the fact that a dollar from a copper royalty is the same as a dollar from a gold royalty. It's a really underdeveloped space. And when you looked at the groups that are out there, they range from being sort of reasonably diverse to single asset companies. So I suppose the niche that Trident saw was, because there is this appeal of mining royalties, particularly to generalists and retail investors, they like that as a way to get sort of protected exposure with upside to the mining sector. The natural next question is, okay, you've sold me on the royalty model, so now how do I get my exposure to mining commodities? And at the moment, you'd sort of say, well, you probably struggle to get that. You could certainly get it for precious, and you sort of have your pick in that regard. But you struggle to get a broad representative exposure to the breadth of mining commodities. So our intent is over time to build a portfolio that's probably reflective of by commodity breakdown. So circa a third precious metals, a third base metals, and then a third bulks and batteries and industrial metals and sort of everything else, which, depending what lens you're looking through, whether it's sort of global revenues or global market caps, that's roughly, give or take, the breakdown of the mining sector. So in that regard, it's almost an index fund like allocation, but obviously from a royalty approach and with these sort of upsides that we talked about.
And are you still in acquisition mode, and how are you actually sourcing your royalty deals?
Yeah, no, we're absolutely in acquisition mode. So part of our relisting, we're also doing a concurrent fundraising. So we'll hope to announce something, fingers crossed, either this week or next week. But we've gotten a very good market response despite everything that's happened, and has probably given us a little heartburn over the last couple of months. The story seems to resonate with people, and I think the strategy. Yeah, it's pretty exciting. We're all excited about it, and we've assembled a good team and a good pipeline of opportunities, and so I think that's being recognized. So yeah, we'll be doing a raise concurrent with the relisting. So as of June 2nd, we'll be on the boards in AIM. We'll be tradable. We'll have cash to deploy, and I think despite everything that's going on, probably no better time to deploy it. You take base metals, for example; they've sort of been kicked in the teeth in this market. But if you can write a royalty over a base metals mine that's got a 15-year mine life and is sort of washing its face in this market, I think that's an incredibly attractive opportunity. So yeah, we'll be certainly in acquisition mode, and we've got a number of conversations ongoing to deploy that capital that we'll be raising. And in terms of sourcing royalties, as I mentioned, there's sort of two buckets. There's the existing royalties that are out there that can be consolidated. In fact, that was our first transaction. It falls into that category. And then there's obviously the ability to write new royalties. So new royalties is relatively straightforward. We sort of tap into our networks. The advisor network in particular is hugely beneficial. So we've got a lot of opportunities that come across our desk in that regard. And then in the existing royalty space, one thing I'd flag is that when you look at the listed public mining royalty sector, all the companies with the exception of one are listed on their primary exchange, being the TSX. And so quite naturally, when you overlay their royalties, very heavy concentration in North America and sort of trickles into Central South America. And then there are certainly royalties sort of elsewhere across the globe, but it becomes a bit more of a smattering there. So I think we see geographic opportunities as well. Places like Australia, obviously a prolific mining jurisdiction, hundreds of royalties in existence, but no publicly listed mining royalty companies at the moment. So we see some pretty clear targets of opportunity, both jurisdictionally and commodity-wise, to go out there and try to aggregate some of these. Because if you can buy a royalty, at a 0.6 NAV as a single asset, risk that's being held by an existing mining company, for example, and you get that into a portfolio, which over time is valued at sort of 1 times NAV, and then as you grow the portfolio, it increases from there. Not only is that an accretive transaction just on a standalone basis, but by the very function of getting it into a portfolio that's more highly valued, you get this sort of extra kicker in terms of returns. So yeah, I think a lot of opportunity to go out there and consolidate sort of existing royalties, particularly in the non-precious space, because they at the moment really don't have a natural home.
And obviously, at the time of this recording, we're in lockdown and going through this coronavirus. How has that impacted your business, and obviously going out and searching for these deals? And how do you see it playing out once we sort of come out of this lockdown?
Yeah, so it's certainly obviously the COVID situation has presented some challenges. Well, and conversely, sort of both good and bad. I'm not sure we'd be able to have gotten everything everything we've done in the last couple of months done if we were constantly on the road, because it's been a handful of work, both in progressing some of these transactions, and then it's a huge chunk of work to file for readmission onto AIM. So thankfully, the bulk of that's behind us. So upon readmission, we're sort of straight back into deal mode and trying to execute on some of these pipeline opportunities. So it's going to be a bit of a challenge, with the sense that you can't travel to site as easily. So we'll have to navigate that. In some situations, if it's a large asset that's been operating for a number of years and the royalty's paying, I think that becomes a little less of a concern. In some cases, existing royalties don't have visitation rights in any case, so you have to sort of get comfort at the asset level without that. But certainly on new royalties, you want to get to site and spend time with management. So it's got its challenges. I don't think anything that's going to delay us deploying capital too impactfully in any case. As I said, we've got quite a few transactions that are underway that the assets are sort of well known to us. And in some cases, we've been able to visit prior to lockdown. So as long as this doesn't sort of extend for another 6 months, I think it doesn't present too much of a problem for us.
Yeah. And do you see sort of down valuations on some assets due to this coronavirus?
Yeah, we certainly do. I mean, there are some companies that, at the moment now they're either just barely keeping their heads above water, despite, it could be a pretty solid underlying asset, using that base metals or polymetallic mine as an example, where, if a lead zinc silver mine is struggling on the base metals front, silver starting to rebound, obviously, but across the board, they're sort of challenged. But if you've got an asset that's sound and is breaking even in this kind of market, to be able to get a royalty in place, on a long life asset, that's an incredibly opportune moment. So yeah, we see it as a good time to deploy capital, and I think it's certainly going to be a buyer's market for the foreseeable future. Probably less so in gold, but it is, it's mining, it's cyclical. So if not gold right now, then base metals and bulks, and then gold will have its day as well. So yeah, we're conscious of sort of the cyclicality, and we'll deploy capital in a smart way.
Yeah. And sort of wrapping up as a conclusion, what's the outlook for Trident Resources and post relisting as well on the AIM on 2nd of June?
Yes, I mean, from there, that's kind of the exciting period. It's time to get down to business and start deploying capital. Because I think one of the exciting things from a royalty company that we didn't touch on is, because it's a portfolio of cash flowing assets, you can go to debt providers and get leverage against that kind of portfolio. And because it's a diversified portfolio, it's typically on much better terms than a miner could get, unless they're one of the sort of bigger boys that have a large diverse portfolio. So really, if we're going to do this equity raise and deploy that capital, with an initial priority on sort of cash flowing or near cash flowing assets, because that does unlock leverage. And this is where Mark Potter's experience at Anglo-Pac has been hugely instrumental, because obviously he was involved in managing their debt exposure. But if we can deploy this capital, build up the portfolio, and then you can go out there and get leveraged against it to make subsequent acquisitions without needing to raise equity and dilute your existing shareholders. I mean, that's just a boon for the share price. And so, we've started having some of the early discussions on what a revolver facility would look like, so that you can draw down on it to make acquisitions. And then, these accordion type facilities that you can then pay down. And when you make your next acquisition, you draw on it again. So the whole time, it's obviously to the benefit of the shareholders to be able to get that in place. So really, for the first step though, is post relisting and fundraising, to go out there and deploy the capital, so that we have that portfolio to get leverage against, and that unlocks things like dividends down the track.
Okay. Really appreciate your time, Adam, and sharing obviously your experiences and telling us about Trident Resources. If anyone wants to sort of reach out to you and ask you any questions, how can they go about doing that? And also, are you on any social media platforms?
Yeah, sure. So obviously through the webpage is easy. That you can email me directly at ad@tridentresources.co.uk. We'll be changing our name soon to Trident Royalties, but everything will flow through. And then we're obviously on LinkedIn and Twitter and everything else. So, we've got upcoming speaking engagements as well, and panels and all that sort of stuff. So yeah, I'd encourage people to start following us on those platforms, and hopefully we'll have some good news to continue to deliver here over the next few months.
Yeah, no, great, and look forward to that as well. And I'm sure the our audience as well will be having a look out as well. So really appreciate your time, Adam.
Absolutely. Yeah.
Stay safe, obviously, amongst these challenging times. And to the audience out there, hope you're all staying safe. And until next time, happy mining.
Thanks, Rob.
Thank you.